Thank you. Thank you. I love hugs.
Go get him.
Thank you. All right, well, thanks for attending tonight. It's great that you're here because you could have been doing a million other things, so pat yourself on the back. When I was getting started or restarted in real estate investing back in 2003, 2004, I used to attend all the local real estate events. I used to go to Bill's Club down in San Diego, which was huge, and it was great because you got to network with a lot of people and learn. I used to go to the LA meetings. I used to go to the Orange County meetings until, things crashed, and then people stopped going. Most people stopped going, and a lot of those clubs closed shop. But what I want to do tonight is educate you. I love educating. I've done so many different things. Now it's my turn to share that and give it all back to you guys. And I love to do it, and I do it freely. But also, I want to inspire you because so many people think about investing, and they don't really take action. They know they should, but they don't. And I don't understand why, unless it's just fear or a lack of knowledge. And we're going to get to that here in a moment because I'm going to ask you a question and I'm going to quiz you. It's not a trick question, by the way. So let me just tell you a little bit about myself, how I got here, because it kind of paints the picture and gives you some context. I knew from a very young age I wanted to be wealthy, and I made it my life's mission to study wealth and money. I wanted to master wealth and money. And so at an early age, in my teens, I started studying business, real estate, and even personal development. I was one of those first people listening to Tony Robbins when he came out with Personal Power on cassette tapes. And I still have that program today with the little paper journal that you write your goals in. So I'm never going to give that away because that was really my first taste of true personal development. But when I started going to university after high school, I didn't know what I wanted to do. I just knew I wanted to be wealthy. And someone suggested that I pursue a career as a police officer. So stupidly, I enrolled in criminology, and I spent 4.5 years studying criminology. I never did become a police officer because within 3 months I knew that's not what I wanted to do. But I didn't know what else to do. At the time, I wanted to be an entrepreneur. And so over the course of time, I started multiple small businesses. Some failed, most failed, some succeeded. But what was interesting about all that, it was an experimentation. And I learned more from doing that kind of stuff than I did from what I learned in university. But at the age of 18, when I could qualify for financing, I bought my first rental, fixed it up, put a sign out on the lawn. There was no internet back then. It was all done with paper and signs. So I leased it, managed it, and held that for a number of years, ultimately sold it mistakenly, but I sold it, and that was a lesson that I learned. But it was pretty much textbook, and the writing was on the wall, and I knew that's the path I wanted to follow. So fast forward to 2007-ish, the internet was all the rage, and all these dot-com millionaires were popping up all over the place. Actually, that wasn't 2007. I take that back. That was 1997. My cousin and I kind of got together and we thought, hey, you know what? Let's create the next Amazon.com for the country club industry. Back then all these people were becoming wealthy, and I thought, hey, that was my ticket to riches. I could become the next .com millionaire. And so we did. We pursued that. So my wife and I packed up, moved to California. We hired a CEO. We raised $9.5 million in venture capital funding out of San Francisco. We started this company. We had 105 employees. And then in March 2000, the NASDAQ crashed, and in that one day, everything disappeared. What I thought was going to be, my riches in a publicly traded company disappeared quite literally overnight. It was just a 1-year decline from that point. We had to lay off 105 employees. I was the third last person to leave. I knew I didn't want to go back into corporate America. I didn't want a job. I knew what I wanted. I just didn't know how to get there, even though I had a taste of it when I was 18. And so what happened is in the middle of 2003, I got this email. I have no idea how I got on this list, but I got an email from Robert G. Allen. Probably half of this room knows who this person is. So he's a famous author. He's one of the godfathers of Nothing Down Real Estate. So I got this email, and he was putting on a free 3-day seminar in Orange County, California. And I thought, well, I got time on my hands. I have the ambition to learn, the desire to achieve my dreams, and I have a dream to fulfill. So I went to this 3-day boot camp. And it was engaging and it was powerful, incredible speaker. Halfway through the seminar, people were running to the back of the room, credit card in hand, spending $15,000 up to $35,000 for these 4 or 5 boot camps, which were peppered around the country. One was on wholesaling, one was on apartments, one was on this, and one was on that. So I whipped out my credit card too, and I decided to go. But it was great, because in going to that event, 2 huge things happened. It was a major turning point in my life. The first thing that happened is I created systems where I could invest from Southern California over 2,000 miles away, and in 9 months I accumulated 84 units, 84 rental units. Many of those properties were sight unseen, but I had the systems in place to be able to do that effectively. And I was investing from Florida all the way up to Michigan. The other thing that happened was I created this business 15 and a half years ago. And really it was to help other investors achieve those same results that I was getting through the systems that I had created from Southern California. And that's how the business came to be. And as a side note, this is normally something I wouldn't say, only because this only became public information yesterday morning at 7 a.m., but my company was named number 925 on the Inc. 5000. So that's public information now, I can actually say it. So I'm very proud of that. Thank you. Thank you. So my mission, and I actually have a slide for this, but my mission really is this. My mission is to help 1 million people create wealth and passive income and put them on the road to financial freedom with real estate. That's ultimately what I want to do. Thank you. Amen. So I'm glad you guys are here. I'm going to dump a lot of information on you real quick, and so this would take hours. I'm not going to take hours. But I'm going to leave some time for Q&A at the end, because I've already had, I think it was Alex, where are we sitting? Anyway, he's in the room here. He was asking me questions out in the lobby, and I thought these are great questions. Let's just include them in the room, because you're probably thinking of some of these same questions anyway. Just real quick, how many people are investing out of state or have invested out of state? Just want to get a gauge. Wow, so about half of you guys. That's awesome. Awesome. Okay, so I've already talked about who I am. I pretty much covered this, and Christina's already talked about my podcast, Passive Real Estate Investing. So I have 2 whys. This is my first why. It's my family. It's a little washed out, but we're all wearing red because it was Chinese New Year in Las Vegas, and we travel a lot. I homeschool my daughter. We're not tethered to the public school system or anything like that. We kind of live a laptop lifestyle just because I built it that way. But we love doing whatever we do, and this is my why. But here's my other why, and it's really already what I told you, and that's to help 1 million people achieve financial freedom. It's not that hard. It really isn't. If you know what you're doing, you're working with the right people, you can get it done. So here's the question I said I was going to ask you. Now I'm going to ask you. Finish the sentence. Ignorance is? Expensive. Oh, you guys listen to my podcast. You're right. Most people say bliss because that's what everyone else says, right? But they don't think about what they're really saying. It can be, but why stick your head in the sand? Ignorance truly is expensive, because what you don't know, consciously or unconsciously, is costing you opportunity, it's costing you money in terms of savings and growing your existing capital, growing your wealth. You don't want to be that person, right? So being here is a step in the right direction, because you're educating yourself. You're taking that step to learn what you need to learn and getting inspired from the other people around you. So let's bust the myth right now. And half of you guys I know this because you invest out of state. The other half I don't know. You're going to have to tell me. But it drives me nuts when I listen to the media, the radio and TV, especially CNBC, and they talk about the real estate market as if it's this one big nebulous blob. Well, that doesn't really exist. There's no such thing as a national real estate market. If there is, point to it. Show it to me. You can't. It doesn't exist. The reason is because all real estate is local. In fact, I would argue that all real estate is hyper-local. It's not just about the city. You can get granular and break it down into smaller and smaller pieces. In fact, I used to go to Detroit a lot, and I used to drive around, and I was buying properties there and flipping properties there. And literally, you could go 2 blocks, and you can go from a street of burned down houses, literally burned down, I'm not exaggerating, to a street that has impeccable lawns and just beautiful properties. And then you can go a couple more miles and you'll be in Grosse Pointe, where you have multi-million-dollar properties. So it's really that diverse. Being local, every single market has its own local politics, and you know this, especially being in California, the whole political issue here. But every market has its own local economy, and that plays into what you guys should look at when you're investing, regardless of whether it's your backyard or whether it's 2,000 miles away, like what I was doing. You got to look at the business environment, and look, you don't need to be an engineer to understand any of this. I'm going to simplify it for you here today. And then, of course, supply and demand dynamics. This is a big thing today because we have very tight inventory across the country, which is compressing the returns, compressing the cap rates. It's making it hard to find good deals. They're out there. It's just harder to find, especially if you're in the commercial space. So supply and demand is a critical factor. Now, I'm going to give you 4 things regarding the differences in the market. And these are the 4 things I look at. These are the 4 things our company looks at when it comes to markets. There's more than this, but these are critical things. If you guys have questions, stop me, but I will leave time for Q&A. So every market has different drivers. If you look at what is happening, the story of that market, you will see that there are things that are causing that market to be popular and driving people to that market. At a very high level, you know that for over 10 years, a lot of Californians have been moving out of the state to places like Las Vegas, Phoenix, Dallas, especially the Texas cities, just because properties are so cheap, relatively speaking, to what you find in California, right? I mean, I'm sure you guys all know this. I love California, but I just don't like the tax, the taxes that we have here, and to some degree, I don't like the political climate. But I love the sunshine. I love the ocean. I love a lot of things about it, so I stay. Every market has different market cycles. We know that markets cycle. Typically, they range from 7 to 10, maybe 12 years, just depending on where you're at and what's going on, those drivers. Median price and median rents are going to play a factor. And again, we're at a 40,000-foot level here when it comes to the market. We're going to get a little more granular as I go. But you have to understand that the median price in a market like San Francisco, regardless of what the rent is, it'll never keep pace. And San Francisco just doesn't become a market that makes sense. And you're going to see in my last bullet here why these 2 things play a role. But that's true. What you see here is true for most coastal markets, from all along the coast of California, very expensive. New York, New Jersey, Washington, D.C., Seattle, Washington. I mean, these places just overpriced and arguably unaffordable and arguably don't make any sense at all from an investment perspective. Property taxes can be an issue. Some states are very expensive. We are the anomaly in California with Proposition 13, having that 1% sales tax, which, who knows, maybe one day could be repealed. But the fact that you could buy property cheaply in the past and lock in a 1% property tax rate is amazing because no other state has that. Affordability, and then this thing called the rent-to-value ratio. I know a lot of you probably understand that. Some people refer to this as the 1% rule, where when your rent is about 1% per month of the median price, you have a good cash flowing property. All right, I don't want to get too mathy on you here. I'm going to show you some examples here. So we have this problem of many markets being unaffordable and not making sense, having no inventory, or just not cash flowing really well. So what's the solution? Obviously, the solution is to invest in the best markets that give you the best returns. They do exist. The United States is huge. We have over 400 metropolitan statistical areas, and if you include micro markets, we have over 600 markets that you can pick and choose from. We have the primary markets like LA and New York, we have the secondary markets like Indianapolis, Memphis, and we have the tertiary markets, which are the outlier markets that have smaller populations. But they all have their pros and cons and benefits, and some of them make sense and some of them don't. So I'm just going to go through this quickly because I understand that you understand what's on this slide, but investing locally gives people a level of comfort. The so-called gurus say, hey, invest in a 1 hour or 2 hour radius of where you live. And that's all well and fine if you're buying distressed properties, fixing them up and flipping them because you're actively involved. But it doesn't normally make sense if you're in a market, unfortunately, that is overpriced and the numbers don't pencil out. If they don't pencil out, just move on. There's other opportunity. Do-it-yourselfers, obviously prefer to invest locally because they are hands-on. And some people think they have more control, but in actuality they don't. But you don't always find the best deals, and that's the problem with a lot of these expensive markets like what we have in California. Now, when you invest in other markets, picking the right market, of course, you can get better cash flows and better returns. And I know a lot of you know that, especially you guys that have like 10 plus properties in Indianapolis and other places, right? Back there. And usually you have better and more stable equity growth because these are what I call linear, not cyclical markets. And arguably you have a lower risk because when you're in a cyclical market like California where you see land values, not so much the properties, but land values cycle up and down, which affect the pricing. When it's going up, you're happy, it's great. When it's going down, it's like, oh crap, what's going on with my equity? Well, if you're smart, you pull it out and you move it to somewhere else where it makes you a better return and more money. So these are the 4 things I look for when I select a market. Am I going too fast? Okay, I have a tendency to talk quickly, but I have a lot to cover, which I want to give you. So slow me down if it's, okay, cool. All right, participatory is what they say, right? All right, cool. All right, so there are stable markets and there are volatile markets. And actually, Christina was just talking about this, but you know, I like to call them linear and cyclical markets because the linear markets, if you look at a historic graph of 10 or 20 years, you find prices are relatively stable. They go up over time because it has to keep up with inflation. That's what real estate is supposed to do naturally. It's a bunch of commodities, sticks and bricks sitting on a bunch of dirt. But some markets, for whatever reason, the drivers, the supply and demand dynamics make that market more cyclical. If it gets out of whack, like we saw in Southwest Florida in 2004, 2005, we were seeing 30% appreciation rates for 2 or 3 years straight. That is crazy, it's unsustainable, and that is very speculative play, and it was driven by a lot of real estate investors from California and other places like that. That was just nuts. So you want a stable market, ideally, and you know, a cyclical market is okay if you are putting cash flow first. Cash flow is king. Cash flow is the glue that's holding your deal together. So cash flow always has to come first. You want strong fundamentals in a market. That means you have a very diverse job, very diverse industry is the word I'm looking for. You have jobs across multiple industries, from finance to hospitality to manufacturing to whatever it may be. When you look at one-trick pony markets like North Dakota was during the oil boom, you couldn't even find a tent to stay in. There was no housing. In fact, even bare land was covered with tents because there was no place to go. Then builders came in, they built like mad, and then when oil prices came down and dropped below $60, $50 a barrel, guess what? They started capping the wells. They didn't need the housing anymore because there were no jobs. They were handing out pink slips. So these people had to move, and they moved back to where they came from. Now you have this glut of inventory, prices come down, and you know, it just doesn't make sense anymore. And that's what happens when you have an industry or a market that's based heavily on one particular industry. So when you have a diverse job market, it leads to a stable economy. Thirdly is that rent-to-value ratio I was talking about. When you have a rent-to-value ratio around 1%, it makes sense. Does anybody not understand the rent-to-value ratio? Do you understand the math, the simplicity of that? One person? Okay. 2 people. Okay, now it's worth it. Now I'll explain it to you. Okay. All right, so this is the perennial example I always use. It's the $100,000 property, which is a real example. If you take a $100,000 property and it rents for $1,000 a month, that's 1%. That $1,000 per month in rental income is 1% of that purchase price or the value of that property. That is, by a lot of people's opinion and standards, that is considered ideal. Now, if your rent-to-value ratio is a little higher or a little lower, that's okay. Take a property in California as an example, as just kind of a test for yourself. Make an investment decision based on this alone. And of course, we want states and markets that are landlord-friendly. Alabama, you know, is a great state because they have very aggressive landlord laws. If you have a tenant that you need to evict, guess what? They're not staying there very long. You know, the sheriff is going to come by in short order, knock on the door. You know, you've got X amount of time, hours, or days to get your stuff out, and away you go. That doesn't happen very often, but if you needed that leverage, you have that leverage on your side. Whereas if you look at markets like New Jersey and New York, if you've got what I call professional tenants that know how to game the system, they could literally stay for months, 3, 6, 9 months if they know how to play the system, and some people do. So landlord friendly is a good thing. Now, there are generally speaking, three types of markets, at least the way we classify them. We classify them as either a cash flow market, which means that you don't see a lot of appreciation. It's one of those linear markets, but you have good cash flow. And these are typical examples. Some of the most popular markets that our clients purchase properties in are Birmingham. Who's the Birmingham investor here? You're in Birmingham. Were you in Birmingham too? Tall guy in the back, forget your name.
Oh, no.
You're in Indianapolis. You're in Indianapolis, right?
I have two rental houses in Memphis. I got
Okay, perfect. Memphis is coming up. Well, actually, Memphis is right there. It's a cash flow market. So these are markets where they're very stable. I call them boring markets. There's not a lot of exciting things going on there. But guess what? They make very stable markets to buy and hold a portfolio in and get cash flow and a good rate of return. If you're measuring your financial performance by a cap rate, like a capitalization rate, you understand what that is, right? Yeah, so these are the markets you're going to find those more appealing cap rates in. But on the flip side of that spectrum, we have growth markets. And these are markets that are experiencing currently and recently very strong appreciation rates. And what I mean by that is they're above, measurably above its historic norm. So if you're in a market that has traditionally been doing 3 to 4% per year, just essentially keeping up with inflation, and all of a sudden it's doing like 8 to 10% for a few years in a row, that is certainly a growth market. Now, if you can invest in a market like that and have good cash flow, then what you have is a hybrid market. And these are also the markets we really like. There's the Indianapolis. Good job. So Indianapolis has actually been a perennial market for us. So has been Memphis for 15 years. Indianapolis more recently has been seeing stronger growth.
Indianapolis investor. High-fiving and doing thumbs up back here.
Yes, good for you. So Kansas City is also a great market. Now, Kansas City is starting to price itself out of the radar of a lot of investors unless you're in the inner city and you're going for $50,000 to $70,000 properties. But there's still deals to be found in Kansas City. We still have inventory, but not the same deal flow we used to have. So unfortunately, it's harder for us to provide our clients properties in Kansas City because it's just not as available as it used to be. But I started buying almost 5 years ago in Kansas City before it started hitting its kind of uptrend. So these are examples of different types of markets, depending on what your investment goals are and your investment strategy, if you will. But more so what your investment plan is, you're going to pick one or more of these properties. You might start building a portfolio here and then move to more growth, or you might start with a heavy focus on cash flow properties and then start putting in properties that are in growth markets so you have more equity growth, more appreciation. I don't like to speculate. It's one of my rules is not to speculate. So I just don't try and swing for the fences and try and hit home runs. I'm happy with singles and doubles all the way. Because if you do this consistently, you're going to build a great solid portfolio and you're going to have the cash flow and you're ultimately going to create financial independence for yourself. So, all right, so those are the three types of markets. Now, I just threw this slide in right before this meeting because Alex was asking me this question. Now, I want to make something clear. Disclaimer. I see all the phones go up. Great. So here's the thing. I track 405 markets across the US. These are markets that have a good blend of cash flow opportunities, because these are at the metropolitan area, the MSA. It's not just the city or a neighborhood. This is the metropolitan area. So you're going to have great areas and bad areas. You have to kind of funnel it down and niche it down to find the right opportunities. But from a 40,000 foot level looking down at these markets, these are markets that offer growth. They are experiencing growth right now, good growth potential, and good cash flow opportunities because they have the numbers to pencil out and make it work for you. The ones that I've bolded, Memphis, Kansas City, Indianapolis, Dayton, Birmingham, those are major markets for us. We move a ton of property in those markets with clients of ours, and Tampa. Dayton, not so much. Fort Wayne, on and off. Fort Worth, it's getting really tough. The inventory fluctuates, and that's the problem we're having in this country, is that there's a shortage of housing, supply is tight, demand is strong. We need about 1.4 million household units per year to keep up with the population growth in this country. We're only producing about 700 to 800,000 units a year right now, and that includes manufactured housing. So we have a glut, not a glut, we have a shortage, a deficit of housing. A big problem. And it's not helping the fact that we can't produce affordable housing because the people who actually can afford to get a home, an affordable home, can't find it. And so good for you as a real estate investor, because if you can get safe, clean, functional housing and provide it to these people, guess what? You're going to do very, very well. So you're kind of at the right place at the right time. Definitely a good time. You got to choose the right place. And that's what we're talking about. Okay? Any questions?
When you're talking about what you have in your system, are you talking about single-family homes? You're talking about multifamily? You're talking about a combination, both storage, mobile homes?
I'm talking single family.
Okay.
We focus on single family duplex fourplexes only because it's abundant. The majority of the housing stock in the US is single family. As you go up to duplex, triplex, fourplex, and beyond, it becomes increasingly harder to find. So,
No, I just was curious because I didn't know. Okay.
yeah, it's a good question. No, it's predominantly single family homes. Often they're 3-bedroom homes, just on its own lot. It's pretty hard to find other kinds of housing stock that is abundant enough to make sense. It's out there, but it's harder to find. That's, I guess, the point.
Okay. No, that's fine. Thank you. Thanks.
Sure. Yes?
So the same rules would kind of apply for the multifamily.
It would. Exactly the same rules. It's just you're just investing in scale. Like duplex is just 2 units connected together. Fourplex is just 4 units connected together, but it's still a housing unit. You still have a tenant. You still have X number of dollars per month in rent. All the same things apply. The valuation of the property starts to change once you get over 4 units, because now you're talking about what they refer to as commercial property. Financing's different. It's not as attractive, but
I meant in the hot market, the market.
no, it would still apply because rents are rents, regardless of whether you're living in an apartment or the supply and demand dynamics are the same. It's going to affect all of those housing types. Yeah. So, yes.
So your office looks for deals, and you can purchase homes through your office.
Yeah, we'll have anywhere from 100 to 200 rental properties available at any given time. We put most of them on our website, but the thing is that a lot of them don't actually ever make it to the website because an investor says, hey, I'm looking for exactly this. This is my buy box. When we know that, those properties go straight to that investor, right? Yeah. So, but yes, they're always available. Yes?
In case of recession, some of these markets have really gone up a lot, right? Don't you expect some sort of downhill, and what would be the impact on some of these markets?
You're talking about a national recession?
Correct.
Not a local? Okay. Recessions will affect a local market if it's grossly affecting the job environment. So if people are losing jobs at a large enough and fast enough clip, what happens is a certain percentage of that population will start to move away. And that's lowering demand for housing. And if it's big enough, then it starts to affect rents or property values or the size of the tenant pool. There's actually a pretty big buffer there right now. So even if we have a mild recession, if you're buying right, it should never affect you. And that was the mistake that a lot of investors made in 2004, 5, and 6. They were buying properties thinking they were investing, in quotes, but really what they were doing is speculating. They weren't buying for cash flow. And they weren't positioning themselves in the right markets, in the right neighborhoods to protect themselves. So when things changed, jobs dried up, and the buying pool for homes and for rentals dried up, you started to see all those numbers change. And people were now, a lot of them were upside down. They were caught with their shorts down. But if you buy and I'm going to talk about this here in a minute, but if you buy in strong markets with diverse economies and a wide array of industry, This is why I like markets that have transportation. That's another industry, is transportation, like Memphis, for example, where you have Dallas, where you have transportation hubs, whether it's airlines, rail, shipping, anything like that. You tend to have jobs that stay there because they need the transportation to survive as a business. So a mild recession, if you have a portfolio well positioned, a mild recession won't really affect you. It's when it really starts to affect a larger percentage of the population from an income and economic perspective that you start to see that. But here's the thing, people always need a place to live. And so we're getting into some advanced stuff, but there's something that I refer to as the socioeconomic ladder. People who are living in your house right now, if they can't afford it because they had to, they lost a job, they had changed job, whatever happened, they have to move down, guess what? They're going to go from a $1,200 rental to a $1,000 rental. But the people who had that same situation happen to them that are in $1,500 rentals in that market now have to downsize into your $1,200 rental. You see what I'm saying? So as long as you have a rental pool that covers that socioeconomic ladder, the people move up and down depending on how good the economy is, how well they're doing. So this is why I like the middle of the bell curve, the bread and butter houses in like B+ neighborhoods, is because you're always going to have people that are going to want to live there or need to live there. Does that answer your question?
Yep.
All right.
Yeah, can you repeat the question, what his original question was? I don't know, I didn't hear it.
The impact.
Also, can you repeat the question because it's not taken?
Yeah, sorry. I usually do. I thought I did. I'm sorry. What would the impact be of a recession? Was pretty much it? Okay. So, Bill.
I mean, great neighborhoods.
Jeez. We should talk about that. Are you setting me up? You're teeing me up. I know you are. All right. So investors talk about neighborhoods as A's, B's, and C's, and sometimes D's. There's really no formal industry definition of this, especially in residential. But we have a general idea of what we mean when we talk about an A-class neighborhood or a B-class neighborhood versus a C-class neighborhood, that type of thing. Here's how I define them, or not so much how I define them, but this is going to be part of the definition. But you have to understand, what I'm about to show you is within the context of the 20 or so markets that we're in, because the numbers I'm going to show you are going to be different in Santa Ana, California, or Irvine, California, wherever it may be. So, but you'll get this pretty quick. I'm going to start with C-class neighborhoods. This is a category that we don't really do a lot in because it's not my favorite. Keep in mind that the median, to put some context on this, the median price of the property that our clients purchase, they range from $80,000 to $180,000, but the median is $122,000. The average is $110,000. So when you understand that, being in California, living in this bubble, or this bubble in a bubble here, right? You're not going to go, geez, that sounds like a garage, in California. So, cheaper prices, often under $70,000. This is what I tell people to avoid. Because, if you're trying to start small and you're buying a $50,000 property in a neighborhood that is really a really low income neighborhood, that $50,000 property probably was a $50,000 property 10 years ago and probably will still be a $50,000 property 10 years from now, unless you have gentrification going on. So I'm not a fan of D-class neighborhoods and lower end Cs. We do have C pluses, and some of our investors really want them, so fine. They're okay. Now, here's the thing. They have higher rent to value, RV, rent to value ratios. You will often see 1.1, 1.2, sometimes 1.3% as a rent to value ratio. That's fantastic. Looks great on paper. Your cash on cash return is higher. Your cap rates are higher. Your cash flows are pretty attractive because your investment is pretty small. So that's why you have the high cap rate. So they look great on paper, and a lot of investors fall in love with C-class properties. I'm not saying they're good or bad. I'm just saying understand what it is. But anecdotally speaking, because of the demographics of the tenants in these neighborhoods, you are sometimes, maybe often, having higher turnovers because they're more transitional. They're going from job to job. Sometimes they like to move, and sometimes they like to move with a wake of damage behind them because they often don't care a lot about their credit or reputation. Am I saying that politically correct? All right. I practiced. All right, thank you. So again, higher turnover, higher vacancy. I don't particularly like that. Here's why. Do you know what your most expensive cost of owning a rental property is?
Vacant.
And turnover. Thank you. Yes, it's that whole turnover which gives you the vacancy. And if there's any repairs or cleanup to do, it's a cost. So with properties like these, because your rents are typically below $1,000, often they're around $700 to $800 a month, whatever you've accumulated for cash flow over the course of the year, if you have an expensive turnover, it'll eat up the cash flow from the year. And if you don't have any appreciation or equity growth, well, you'll have equity growth if you're amortizing the loan, but if you don't have any appreciation, you really don't have much of a return at the end of the year. But it's not uncommon for tenants to stay 2, 3, even 4, 5 years. If you have a nice home in a nice area, even if it's in a C-class neighborhood, okay? All right, we covered the C's. Oh, financing issues, forgot. This is a big problem. So the problem with a lot of neighborhoods that have properties that are sub $70,000-ish, okay, again, we're not talking about California here, is because there's a lot of rentals and not a lot of retail sales, you don't have a lot of comps, or what are referred to as comparables. So when you have an appraiser go out to get financing for you, you're not going to be able to get financing, or it's going to be difficult. You're not going to get the value for what on that appraisal for the property you're purchasing, and that's a problem. Aside from that, a lot of lenders don't like to lend on properties that are that have mortgages below $50,000. So kind of the break point is $65,000. When you're below that, it's typically an all-cash purchase. So I love financing. I love leverage. That's one of the beautiful things about real estate is the ability to leverage your investment and magnify your returns. You can't do that in C-class neighborhoods, or not as well. The other end of the spectrum are A-class neighborhoods. Now, these are higher prices, and I should be adjusting these numbers a little bit today because this is from about 6 months ago, maybe a year ago. So in the areas that we're in, often you'll start to get into A- type neighborhoods around $140-ish thousand. These are nice neighborhoods. They're not high end. I mean, it's not necessarily this type of property, but it's a better demographic, usually middle income to upper middle income in terms of the demographic. Lower rent to value ratios, so we're talking 0.8, 0.9. They don't look as good on paper. They still are attractive. They do cash flow. But the beautiful thing about A-class neighborhoods is they have lower turnover, lower vacancy, and very few financing issues because these are retail areas. There's a lot of retail sales. There's a lot of comparables that appraisers can pull from. So financing is very rarely an issue. And there's a lot of stability in property values because there are a lot of sales. You can see property value trends very clearly. That rarely becomes an issue. What I don't have on here is one more bullet, and that is that these areas tend to appreciate better than B's and C's in a stable and a growing market. In a softening market, they will depreciate just like everything else, but much slower and to a smaller degree. So there's more stability or security, if you will. Think of this as more like a blue chip stock, if you will. Now, in between is your B-class neighborhoods, and these are like the hybrid markets I was talking about before. So it's a combination, or a combination of good growth potential with cash flow. And you'll often find these around the $80,000 to $130,000 price range, again, in those 20 or so markets that we operate in. The rent to value ratios are quite moderate. They're usually floating around 1%. That's kind of the target that I shoot for. They look good on paper. They have lower turnovers. You still have a good demographic. Again, this is middle America. These are people who are making $40,000 to $80,000 per year. It's kind of the median in terms of income. Low vacancy, low turnover. I like these. My favorite is typically the B plus and even the A minus, but I like the B plus class of property because I have great tenants, especially if you have good management. They stay for years. The numbers make sense. And when you get to year 3 and year 5, things really start to shine on that property because now you're seeing the equity growth. You're seeing rental increases, maybe not every year. I don't raise rents every year, but I will every like 2, 3, 4 years. If I have a great tenant and I'm making a good return on the property, I'm not going to touch the rent. I'm just going to leave it. When they eventually move out, then I'll bump the rent up. That's just my way of keeping my tenants. And these are still easy to finance because typically you're going to have 50 to 70% of the housing stock in these areas sales, like retail sales. They're homeowners. Now here's my personal qualifier. This is my litmus test. Just like we have the 1% rule for the rent to value ratio. That's my litmus test. This is my litmus test. If the neighborhood doesn't have a retail buyer, if there are not enough retail sales, there has to be retail sales. If there aren't any retail sales or enough of them, I don't buy in that area. Because my exit strategy, if and when I want to sell that property, which is usually never, unless I'm doing a 1031 tax-deferred exchange, I want to know that there's a retail market to buy that property so I can sell it and sell it relatively quickly. Plus, if I know if there's a retail market, I'm going to have appreciation because there's demand for housing in that neighborhood. So that's my personal qualifier. Okay. Yes.
Can you define that a little deeper, what you mean? I know what you mean by retail buyer, but what would a market look like that had no retail buyer?
It would be the C and D class neighborhoods because you have predominantly renters in that market. I assume everybody heard your question, right? Yeah.
Would you repeat it just
Yeah.
for the-
So what would a market, or not so much a market, Christina was asking, what does a neighborhood look like that has low to no retail buyers? It's typically your C and especially your D class neighborhoods because you don't have a lot of sales to homeowners. The sales that are happening in those markets are low in quantity, and they're often from investor to investor, or sometimes from a bank to an investor. So you don't have a lot of homeowners coming in and buying, and so you don't have those sales comparables on the MLS to support an appraisal that comes in to help you get financing for those properties. I want to see buying activity to homeowners because I want retail sales. I want comparables on the MLS. I need to have that. That's my litmus test.
Thank you.
Yes?
Is it possible to turn a CD neighborhood into a B neighborhood with enough investment? And if so, how would one go about doing that?
You're chasing a unicorn, aren't you? The question was, is it possible to change a C-class neighborhood into something better?
Yes.
With a lot of effort and a lot of capital, it is possible. Now, that happened in downtown Detroit. But keep in mind, there were hundreds of millions of dollars that came into downtown Detroit to revitalize downtown Detroit and turn it around. And now you have some amazing condo developments all along the river. Is it possible? Yes. It's extremely difficult, though. Because when you talk about a neighborhood, you're typically talking about hundreds, sometimes thousands, but hundreds of properties. It could be as large as a zip code. So yes, it is possible. Smaller neighborhoods, certainly easier if there's enough people revitalizing it. But this happens at times in cities through gentrification. Like when you have this area that's just been, a dump for so many years, and all of a sudden they build a stadium nearby, and all of a sudden people are coming in and buying all the properties all around it and fixing them up. That's an example of going from a D plus C minus to something that is like, oh man, everybody wants to live there because now they've got coffee shops and they've got a social life and all kinds of cool things going on. Yoga, yes. You have to have yoga along with the Starbucks.
Moving out a certain type of person because of that. So does real estate make a neighborhood better or worse?
That's a great question. So the question was, does that make a neighborhood better or worse? I know the debate on that. It's a philosophical question to some degree because the argument is that when you improve a neighborhood, you're squeezing certain people out of it that can't afford it anymore. It is displacement, and it happens all the time. And I'm not saying it's good or bad, but the thing is if something is happening organically in an area and it's improving the area, less crime, nicer communities, more pride of ownership, it actually overall is a good thing. there's still places for people to go and live. Unfortunately, it's not going to be there. And here's the other thing that happens. People who do have properties there often get paid fair market value or a lot more than fair market value because they're just saying, wow, this is a windfall for me. I'm going to take the money and run. And then someone else comes in and turns it into its highest and best use. So in that situation, it's actually a win for both people. You don't agree? I know you don't agree. Like I said, this is a debate that's been going on for years. And look, I know what you mean. Who was next? You were next.
For your personal qualifier, do you have a threshold of, 40% renters, 60% ownership in the area that you're investing in?
A minimum of 50%. Homeowner occupancy rates should be over 50%. Who was next? You were next?
Some investors, when they look out of town, they like to see a Walmart there or other certain. Do you have any kind of tricks like that you?
That's a function of, well, the question was some investors look for Walmarts or whatever it may be.
Dollar General versus
Yeah.
whatever the other dollar stores are. There's like kind of
Yeah, those are called amenities, and yes, you want them, but it's a function of the quality of the neighborhood. You're not going to find a Nordstrom's in a C-class neighborhood, and you typically won't find a Walmart in an A-class neighborhood, right? So it's really, those retailers and those businesses follow the income of the demographic that lives there. Does that make sense?
It does.
So if you're,
So you're looking more property values first, and then you might, oh, there's a Walmart, that's good. You're not going into an underrated neighborhood and say, hey, Walmart's there. We're going to look deeper in this.
having a Walmart there is great. It's actually great. Having Walmarts and Starbucks are great. Yeah. But you're not going to find the Walmarts in A-class neighborhoods. So if you're trying to find the combination of those two, you're not going to find it. Yes, sir?
Do you use kind of visual cues in neighborhoods to kind of class it, like if there's a lot of bars and windows and auto zones and liquor stores as opposed to clearance in the driveways? I mean, are those, or is it always just simply numbers?
Bars in the windows, huh? That reminds me of Detroit as well. Yeah, I see a lot of that. Yeah, well, that is certainly a tell, right? Yes, if you are driving through strip mall areas and commercial areas within a neighborhood and you see bars on the window, you probably are in a C-class, maybe a D-class neighborhood. It just goes hand in hand because you're going to see that there are more not violent crime, but vandalism and petty crime, like theft. And so the businesses are just protecting themselves. You got hoodlums, you know, they don't want a brick thrown through their glass window. So yeah, they bar them up. You're not going to find that here or around this hotel.
Right.
But this is probably a premium area, right? It's just kind of if you think about it, it's kind of common sense. A lot of that is actually common sense. But there are a lot of resources and tools online. Like a lot of this information is free. You could look it up online and see what the demographic profile of a neighborhood is, and you can draw your conclusions pretty quickly from that.
Yeah.
Crime statistics are available. I mean, all that stuff. So, so city data is good, but it's not great. It's dated. Question is resources. Yeah, so Neighborhood Scout is very good. It is a subscription-based site. Neighborhood Scout is a subscription-based website, but they have a lot of really good information, a lot of really good data. To a very small degree, Zillow and Trulia have pepperings of that kind of information, particularly school and crime data. But Google is really your best friend, a search engine, because if you type in the name of a city and you put like a two-word phrase after it, like I pick on Detroit a lot, I'm sorry, but Detroit, Michigan crime statistics, or Detroit, Michigan population growth, or Detroit, Michigan job growth, anything like that, you'll find a ton of information. And a lot of it are articles, but if you read the articles, they cite all that data and stats, and they even have references to the sources so you can backtrack it. So if you're a little bit of a sleuth and you spend 30 minutes online, you can find a ton of information. Okay? All right, moving on. I'm going to give you 3 quick examples. these are actual properties. One of these were mine, not this one. So here's a $75,000 property. It rents for about $850 a month. We sold this last year to a client, an RV ratio of 1.1. It's a 3-bedroom, 2-bath, 1,300. This is what I call bread and butter housing. I'm not used to having this on my head. This is bread and butter housing, okay? This is a B-class neighborhood. It's just a cute little house that performs really well, and you get a good tenant in there, and they're going to stay for years. That's just the way these houses work. Now, I'm going to put something else on the screen here. It's a lot of rows and numbers. I'm going to change this, but don't let your eyes glaze over because there's really only 3 things I want you to focus on. So I'm going to actually go over here and use my laser pointer. This is actually a screenshot off of our website. There's a very detailed financial calculator that you could use, and you can actually change all these numbers. But here's what I want to point out, is this property gives you annual cash flow, and increases year over year a little bit. It gives you equity growth. Equity growth happens through the amortization of the loan, plus you have to make an assumption of what appreciation is going to be on average over time. We try and pick low numbers from 3 to 5% in most cases. But whatever it is, your equity slowly grows a little bit year after year after year. And then at the bottom here, the 2 things I want you to just notice, you don't have to memorize this stuff or know the math because it's done for you, is what your cash on cash return is. That's the return you're getting, the immediate return you're getting on the down payment that you've put up right from the get-go, from the beginning. And you'll see that, often, these are double digit, especially in B-class neighborhoods and in the sub $100,000 price range, you're going to get double digit cash on cash returns. Then you have a total return on investment, and last but not least, for those people who have commercial real estate on your mind, or you understand the most advanced metric in real estate investing called the IRR, the internal rate of return. If you don't understand it, it's beyond the scope of today's conversation, but for those people in the room, you're holding this property and selling it after 5 years, you'll have a 20% yearly internal rate of return. This is your true net return on this property, which is fantastic. Where else are you going to get that? Right. Example number 2. Now, I want you to know that this was a cash flow market. In this example, I'm going to a hybrid market, which is a combination of thank you, is a combination of cash flow and growth potential. Now, this one was my property. So in this particular case, it's a $145,000 property renting for about 1%, $1,400 a month, right? So that's that 1% RV ratio. Still 3-bedroom, 2-bath. It's an A- neighborhood. It's in a good area, very low crime, good school districts. Not great, but good school districts. Big tenant pool. This will always be leased. So here, the cash flows are a little higher because the rents are higher than the previous example. The growth potential is a little stronger as well. Our starting point is just as high. But one thing I want you to notice is the cash on cash return is typically the upper single digit. There's always a give and a take. If you want more appreciation potential, you're going to give up on your cap rate and cash on cash return, just the way it works. But again, if I sold this after 5 years, based on these assumptions, we have a slightly higher internal rate of return. It's more like 33% instead of 20. So I'm doing better overall with this type of property than I am with a C-class neighborhood property. Last but not least, my third example, growth market. Jacksonville, Florida is a market that we've been in for about 5 years. A lot of growth opportunity there because it's a market that has just been growing strongly in population and in jobs because of the port. So that's the story there. But now this is new construction. That's why it's quote unquote more expensive. But $180,000 property renting for $1,400 a month, you might think, not that great. An RV ratio of 0.8%. But it's a nice 4-bedroom new construction home. It's in an A-class neighborhood. The first thing investors notice is that the cash flow isn't as attractive. It's like, but it's only $120 a month. Now this is true net. This is after deducting for vacancy allowance. This is deducting for maintenance and repairs. This is a number. It's not like I'm going to inflate this for you. It's, this is being realistic. It's not sexy and it's not exciting from a cash flow perspective. But these areas, and often with new construction, tend to appreciate, especially in the first 3 to 5 years, faster than the surrounding areas. And tend to have a lot more stability and demand. Not a lot of new construction in the country these days. Builders, are are kind of still a little gun shy, and some of their properties, about 10% of their housing stock or their inventory is being sold to the iBuyers, like the Invitation Homes and the other Wall Street companies, because they're buying these things and renting them out. They're banking on this. They're speculating a little bit. They're banking on that, not so much the cash flow. But in either case, given the fact that lower cap rates, lower cash-on-cash returns, over the first 5 years, because of the stronger appreciation potential, your internal rate of return is almost double what it is in a C-class neighborhood, assuming that this unfolds. So if your goal is growth and rapid wealth creation, you want your portfolio skewed here. If you want to sleep comfortably at night, no stress, and you just want to build passive income, focus predominantly on C pluses and B minus neighborhoods. They're stronger on the cash flow side. It's really a question of where you stand, okay? So to wrap things up, I'm just going to go through the process. This is a 20,000-foot view of what I created, what we do, in our company with investors. You can do this on your own. It's not hard. It just takes time on the front end. But once you've built the system that I'm just going to run through, you will have the team in place to help you just execute. And some of you guys are already doing this. So start off by defining what your goals are. What is your investment goals? What are you trying to achieve? Have an objective, and then map that out. Create yourself a roadmap of how you're going to get there, and then build a criteria around it. What are you looking for? Is it $100,000 to $130,000 homes, 3 bedrooms in BB plus neighborhoods? Great. Don't look at anything else. Focus on that. Decide on what types of markets, your neighborhoods, your cash flows, whatever it may be. The more clearly you define this, the faster you're going to find what you're looking for. Otherwise, you're just, shooting in the dark, right? So after you've defined your goals and your criteria, you start to research the markets. There's a lot of information out there. I've talked a little bit about it today, but pick the market. Could be Memphis, could be Kansas City, could be Jacksonville. Once you've picked the market, now is the very important part, and it's assembling the right team. You want somebody on the acquisition side, whether it's a real estate agent or broker, a turnkey provider. Those are really the main deal sources, unless you're fishing on Zillow and trying to shop it yourself. It's good to have someone who knows what they're doing and what they're looking for, or they know what you're looking for, and they understand the market. They understand the neighborhoods in the market. But you want your deal source, number one, professional full-service property management, someone who's got a great reputation and very reliable, because your property manager is your asset manager. They're probably one of the most important people on your team. You have a good management company that's putting good qualified tenants in your properties, you're going to have very few headaches, and you're going to have a great experience, and you rinse and repeat, and you keep doing that. Of course, the other people on your team are your asset protection attorney, your tax strategist or advisor, of course your lender or lenders, the people who are giving you the financing, 75 to 80% of the financing that you're going to need to acquire your properties. That's critically important. This is all already wrapped into one tight package because we've been doing this for so long, but you can do this, and you should do this if you're investing outside of your local market. But you know what? Even if you're investing locally here, you still need the right team. You can't separate team from success. So once you start looking at properties, you analyze them. You're basically underwriting the deals. You decide what makes the most sense for you. If you have a short list of good properties that meet your criteria and you're excited about because they make sense logically, objectively, not emotionally, put it under contract. And do your due diligence. And never skip doing your due diligence. Always do your inspections. Work with your team. They're there to help you succeed. That's why they're professionals in those particular areas. Put it under contract, do your inspections, verify the information, do what Ronald Reagan said, trust but verify. You always want to verify the information. And if you do that, guess what? You're going to have your next rental property. And then you just start going through this bottom part process over and over again. So decide what kind of investor you are. You're either an active investor or passive. You're active, you're flipping properties, wholesaling properties, fixing and flipping. You're doing a lot of the work. If that's not you, great. Do what I do, be passive. Invest for cash flow, invest for building a portfolio, build it up, and do it with the right team. I'm just going to not even go through this. It's just you can see what we do. You already know what we do. We're a turnkey provider. We have private lending. We do syndications in not all the time, sometimes, in apartment complexes and whatnot. Sometimes we have cannabis projects, of all things, because guess what? It's a growth area. That's it. So how was that?
Yeah, you're great.
Okay. So when it comes to property management, definitely have conversations with them. You're interviewing them. There's a lot of questionnaires online that you can find. You could search, even on Bigger Pockets, all kinds of places. The bad thing about those questionnaires is they're exhaustive. They could be up to 100 questions long. Nobody's going to stay on the phone with you asking 100 questions, right? It's ridiculous. But you can do some research online to find good and the bad. Now, not everybody's 100% squeaky clean. There's always going to be upset people that are going to post things because so-and-so didn't call them back, within 2 days or whatever happened, right? You want to see mostly good stuff. You want to talk to some people who are working with them. If you ask for references, they're always going to give you their best people. They're never going to give you someone who's going to talk bad about them. So references only go so far. Just do as much research as you can online and interview them and get a warm feeling in your belly. You have to have a good feeling about them. And then definitely review the contract that they give you. Make sure you're comfortable with everything. Better yet, have an attorney review it. And also, never set your threshold for what they can spend on your behalf over $250, $350, maybe $450. They have to call you if there's an expense or a repair above that amount. Don't give them a blank check, where they can just bill you for whatever. So that's the starting point to interviewing a property management company. Yes?
So I see you have a turnkey company. I've worked with one before. They're in a lot of the same markets as you, and it sounds like they have similar operation. So my question to you is, what do you guys do that would separate you from your competition?
Oh, interesting question. Okay, so the question is, what do we do or why are we different that separates us from our competitors, which are few? And that's a great question. So first of all, I will say that I know most everybody in this industry. Some of them are friends and some of them are, let's say, not friends. And I say that because I started this 15 and a half years ago, and I literally had one of my so-called competitors in my face in the same boardroom telling me that they're going to copy my business. This was 2 years after I started. They're saying, I love this, I'm going to do this too. I mean, I'm paraphrasing, but that's essentially what they did. They have very few friends in the industry, by the way. But I know a lot of the people. The most important thing in this industry, by far, is a person's reputation or a company's reputation. It's pretty easy to find crap online about any company, and it's pretty easy to find good stuff. And it's pretty easy to find a lot of testimonials, and I can give you literally 150 people today that have had nothing but awesome experiences with us. There's no issue with our clients. I mean, I can give you like dozens of people. But looking online and just seeing how people react and respond to what you've done when problems come up, how you've handled them, do you actually resolve them? Are you there for them after the sale? Those are important things. We vet our providers and all the people that we work with. We kind of have a minimum standard. It's not published on our website because we're rebuilding our website right now. We have a brand new version from the ground up launching in a month from now, but it will have a minimum provider standards page. That is what we expect from the people that we work with, our boots on the ground. So those are a lot of the things. I'm sure there's a lot more. Oh, in our team. If you talk to the people in the industry, they'll tell you that our team is, I don't know what the word is that they use, like rock stars, or like we've just basically got the best people in the industry, the most knowledgeable. They're all licensed. They're all investors. They all walk the walk and they talk the talk and walk that walk. Yeah. Oh, that's another thing. Thank you. Yeah.
The bill number is what you're going to do what they don't want.
Yeah.
Leaving a few pieces out that might make the deal look a little sweeter.
Yeah, like I made a comment before. Thank you for that. I made a comment before about the numbers being true net numbers. Some companies will inflate their numbers, and they won't budget or take out vacancy or maintenance and repair, or they'll put really low numbers. That's not really fair. I mean, yeah, that cash flow is going in your pocket. It's not really being spent this month or next month, but eventually you're going to be spending that money. So deduct it now. Just assume it's spent. One last thing I'll say about that too. There are some, I'm not going to mention names, but there are a couple of companies out there that are selling you properties above fair market value, above appraised value, and they flat out tell you up front they're doing it. And if you're okay with it, you know, you can work with them. I personally think that's unfair, but people still buy those properties even though they're paying above market value. That's not for me, that's not cool, but whatever.
One of the examples is like, this one for instance has, you know, 2 property managers, 2 contractors, 2 of everything in every market in case, you know, one goes under, one dies.
Yeah, that's.
Do you have something similar? Or?
Yeah, we'll have 2 to 3 of virtually everything in every market. But people come and go. Like, you know, there may be some builders, and there are builders that we were working with years ago. Numbers don't make sense anymore for them, so they've moved on. They're doing other things, or they've moved to other markets. So that just happens. Real estate is constantly changing. There's an ebb and flow. It's like a pendulum. It's never static. There's no such thing as equilibrium.
One last question.
All right, I don't know who was. I think you were next. I'll stay. I'm going to hang around afterwards anyway.
We'll handcuff him to a chair. We'll throw his car keys. It's all right. He'll be here.
Only if you stay, I'll stay.
Oh, I'm here till about 1 o'clock in the morning.
Oh wow. Okay.
You don't
Well,
want to stay as long as I stay.
no, I don't.
So, in the process, what is the fees from your end, from your staff, and looking for the properties?
What do you mean the fees?
Do you have any associated fees if we purchase a home from you?
0. Always. We never charge a dime ever. It's a value-added service. We've put everything together for you, and it's there if you want it. Yeah. That was an easy question.